This is the story no one speaks about. A silent accumulation, a buildup of forces behind the scenes. A betting game not on tech startups, nor on real estate, but on something far older, far more elemental. Silver, and not by small investors with coins, but by titans, billionaires, old money, hidden hands, working while markets sleep. By 2026, this bet could ripple through the global economy and expose cracks no headline will prepare you for. A quick montage. Global stock market tickers flashing downwards, currencies wobbling, industrial plants humming, solar panel factories rolling out rows of modules. The silver bar vanishes, replaced by fast-paced graphics, bar charts, supply-demand curves, a rising line named silver price, because silver is no longer a side act. It is the main stage. What follows is not a fairy tale. It is not speculation dressed as hope. It is, instead, a descent into data, into behavior, into patterns that reveal how a group of insiders may be quietly stacking silver as global systems teeter. To understand it, we have to travel back. Silver has always danced between two identities, precious metal and industrial raw material. In the shadow of its larger sister gold, it was often overlooked. But history shows us that silver tends to rise when the foundations of finance shake. In 1980, a dramatic spike, driven in part by the audacious moves of wealthy speculators, sent silver prices soaring. In 2011, amid post-financial crisis turbulence, silver again climbed into the upper 40s per ounce. Then, like a tide receding from the shore, it fell, a wall of inertia dragging it down. Looking at long-term data, silver spent decades languishing. For much of the 1990s and 2000s, it traded in the low single-digit to low teens inflation adjusted per ounce, reflecting slow mine production, weak investment interest, and waning demand from traditional industrial users. Yet those episodes left a mark. They revealed a crucial truth. Silver is vulnerable, but when forces align, it can surge. But those surges were once seen as anomalies. Now, by 2025, they look like part of a larger design. Between 2021 and 2025, something changed almost imperceptibly, until the pressure built and began to show. Industrial demand exploded. The modern world, racing toward electrification, renewable energy, and digital infrastructure, rediscovered silver's value. It isn't just for jewelry or investment coins anymore. Silver is critical for solar photovoltaic cells, for electronics, for EVs, for 5G, for everything that pulses with energy in a modern grid. According to recent data, industrial demand has grown sharply. Areas like electrical, electronics, solar, automotive, and infrastructure are consuming more silver each year. Yet global mine supply and even recycling failed to keep pace. Silver is often a byproduct of mining for other metals. When miners prioritize bigger base metals like copper or zinc, silver output gets squeezed. As of 2025, supply remains essentially flat relative to years prior, pushing the market into a structural deficit for a fifth consecutive year. By the middle of 2025, this deficit became impossible to ignore. The industry numbers across multiple reports converged, global demand outpacing supply, inventories thinning, especially in exchange and vault stores that once buffered shortages. In this vacuum, silver stopped being just a commodity. It became a strategic asset. The bull market in silver did not emerge from solar factories alone. It emerged from Wall Street, from vaults, from funds. Exchange-traded products, silver ETFs, and ETPs have been steadily growing. In the first half of 2025 alone, global silver-backed ETPs pulled in a net inflow of 95 million ounces. That surge exceeded the total inflow of all of 2024. By mid-year, total holdings of silver ETPs reached approximately 1.13 billion ounces, valued at over $40 billion. Close to the peak of 1.21 billion ounces seen in February 2021. What does that mean? It means a significant portion of silver that could have gone into industry, into factories, into solar cells, instead stood locked in vaults as paper silver or institutional holdings. That silver was effectively removed from the liquid supply that industries, refineries, and physical metal buyers rely on. Meanwhile, lease rates for physical silver, the cost for industrial users or traders to borrow silver for delivery, spiked 2 levels, not seen since early 2000s. Analysts at major financial institutions pointed out that 2025 may have as tight a net physical silver balance as ever recorded. The consequence? More demand, less supply, increasing competition among industrial, retail, and investment users. The stage was set for a squeeze, or worse. It is in this context that the insiders, the wealthy, the connected, quietly began to accumulate silver. Who are the players, and why silver? When we speak of billionaires betting big on silver, it's not a tabloid exaggeration. The financial flows suggest that major institutions, funds, and possibly family offices, the kind of investors big enough to move markets, are quietly positioning. We may never see their names on social media posts. Instead, their activity shows up as rising net long positions in futures markets, increasing inflows into silver-backed ETFs, and shrinking inventories in vaults. By late 2025, net long positions on the main futures exchange for silver had reportedly climbed 163% compared to end 2024 levels. Simultaneously, demand from institutional investors, those who use ETFs, large fund allocations, and vault storage surged. Why silver? Because compared with gold, silver offers a unique combination of leverage and scarcity. Gold is expensive and heavily held by central banks. Silver is more accessible, easier to accumulate in large volume, and far more tightly coupled to global supply-demand imbalances. Analysts at major banks have pointed out that in tight markets, silver tends to outperform gold because small shifts in supply or demand reverberate more dramatically. Moreover, as global macroeconomic conditions deteriorate, debt piling up, currencies under pressure, interest rates fluctuating, silver begins to look less like commodity metal and more like insurance. By mid-2025, the signals became hard to ignore. Silver broke past the $35 per ounce mark, the highest in over a decade. ETF inflows surged, vault inventories shrank, lease rates rose. Physical demand from industrial users didn't slow, especially given surging demand from solar, electronics, EV production. Some analysts began talking not of a rally, but of a squeeze, a market under pressure, where any large-scale move, a policy shock, a big buying wave, could tip the balance. Yet, for most of the public, silver remained invisible. Gold got headlines. Tech stocks dominated conversations. The big money moved quietly, silent, calculated, patient. To understand how this accumulation works, one must peer behind market mechanics. Silver is not mined for silver alone. For decades, most silver has been a byproduct of mining for other base metals or gold itself. When those metals enjoy high prices, or when miners prioritize them, silver output remains flat or falls. That dynamic creates supply rigidity. Even if silver prices rise, production doesn't automatically follow. Meanwhile, recycling and scrap supply, once a buffer, have failed to scale sufficiently. Electronic waste is growing, but silver scrap from solar panels, electronics, or industrial waste is often locked in complex supply chains, making it difficult to reclaim quickly. On the demand side, industrial silver usage is pricing elastic in many sectors. A solar panel manufacturer building capacity in 2024 to 2025 may have long-term contracts. A small bump in metal costs doesn't halt production. Instead, they pay more or pass costs downstream. As silver becomes scarce, industrial and investment demand begin competing, a dangerous mix. Further, the financialization of silver via ETFs and futures has created layers of paper silver. These instruments allow big investors to accumulate silver without needing to store or move physical bars. But behind them lie vaults, warehouses, and logistics, and those capacities are finite. As more silver moves into financial instruments, fewer bars remain accessible for real delivery. That amplifies scarcity, especially under stress. Finally, lease rates. When industrial users or refiners want physical silver quickly, they have to borrow from vaults. If lease rates spike, as they did in 2025, it becomes expensive to secure silver for real-world needs. High lease rates are a red flag, signaling physical tightness, not just a speculative rally. These are not random market fluctuations. These are systemic mechanisms, quietly working, and right now, they are leaning toward a major imbalance. This unfolding story echoes the past. In 1980, a tight supply, aggressive accumulation, and speculative fervor, combined with economic upheaval, produced a dramatic spike in silver. That spike collapsed when external forces intervened. Regulatory changes, shifts in demand, macroeconomic stabilization, and a return of supply. In 2011, the backdrop was different. Post-financial crisis instability, quantitative easing, flood of liquidity, but the pattern was similar. Demand surged, price spiked, then retraced. Many early investors were burned by the collapse. Today, some of those old forces are back. Macroeconomic instability, high debt levels globally, weakening faith in fiat currencies, growing need for raw materials for green energy, supply constraints across base metals, all combined, but the difference now is scale, sophistication, and institutional participation. If 1980 and 2011 were waves, 2025 might be a tsunami, not just in price, but in structural change. And if history warns us anything, it warns that surges built on imbalances, not on stable equilibrium, often end in dramatic corrections. Why billionaires and what's at stake for a billionaire or major institutional investor? Silver today represents a rare asymmetric bet, relatively low entry costs compared to gold or other hard assets, potential for high upside, and a strategic hedge against macroeconomic collapse. But it's also a statement that underlying global systems, currency, stability, supply chains, industrial growth may falter. Betting on silver now could mean betting not just on price, but on structural change. Large holders may also benefit from illiquidity. When supply is constrained, those with vaults, warehouses, large capital, and logistical reach can hold physical silver or paper silver that smaller players cannot. In a squeeze, they may profit disproportionately, accumulating while retail investors scramble or panic. Moreover, as industries face higher metal costs, these holders may influence supply, pricing, even industrial policy, quietly shaping the production of solar panels, EVs, electronics, or other silver-dependent technologies. In essence, they aren't simply betting on silver. They are betting on a shift in the economy, in energy, in technology, even in geopolitics. In the first half of 2025, global silver-backed ETPs saw net inflows of 95 million ounces, pushing total holdings to around 1.13 billion ounces. Industrial demand, electrical, electronics, solar, automotive infrastructure has surged, with silver consumption in those sectors growing markedly since 2016. The global silver market has been in structural supply deficit for at least 5 consecutive years. Forecasts for 2025 suggest a deficit between 117 to 149 million ounces. Vault inventories and deliverable silver in Western warehouses, for example, under oversight of major markets, have plunged over the past several years, tightening physical availability. Lease rates for silver, the cost to borrow metal for industrial or delivery purposes, have spiked to multi-decade highs in 2025, signaling acute physical scarcity. These aren't anomalies, they are structural signals. Why is all this happening quietly? Because for many insiders, silence is the greatest leverage. Publicity around a silver boom would attract retail money, possibly destabilizing vaults, increasing premiums, and triggering regulatory or tax scrutiny. Institutional players rarely want that. They prefer accumulation in the shadows while forming networks of storage. Vaults in London, in New York, in Singapore. They walk the tightrope between paper market and physical market, shifting subtle weight as needed. They also have the resources to handle the logistics vault fees, security, transport, legal compliance that retail buyers do not. They can secure long lead time contracts for delivery, hedge across multiple jurisdictions, and move large quantities silently. Furthermore, these players may hedge against multiple future scenarios: currency depreciation, debt defaults, supply chain collapse, energy transitions, regulatory changes, even geopolitical shocks. For them, silver is not just a commodity, it is a form of insurance. But this strategy is not without danger. In fact, by 2026, all of the hidden structural tension may begin to explode. Because when supply is fixed and demand climbs, the only way to satisfy demand is to deplete inventories. Vaults empty. Lease rates soar. Industrial users, solar panel manufacturers, electronics firms, EV producers face shortages, high input costs, and potential disruption. At the same time, with so much silver locked in ETFs or held by big players, there is a liquidity paradox. There may be paper silver, but physical silver becomes scarce. When something triggers panic, a major economic event, a policy shock, a large-scale selling wave, markets may freeze, deliveries may fail, prices may gap. This is not speculative doomism. It is economic mechanics. Supply, demand, storage, financialization. They obey limits and laws, not hopes. If 2025 was the quiet buildup, 2026 has the potential to be the reckoning. Why should we care beyond price? Because silver is not just a commodity. It is a barometer of industrial transformation, of energy transition, of supply chain stress, of monetary instability. The green transition, solar energy, electric vehicles, digital infrastructure is real. It needs metals. Silver is among the most important. As demand grows, supply constraints become more dangerous. What we are witnessing is not a simple metals rally, but part of a structural transformation in global economy. From fossil fuel industries to electrified, digital, sustainable systems. At the same time, the financialization of silver via ETFs vaults, futures reflects a broader trend. Modern finance does not just invest in companies or debt or currencies, it invests in materials in the very atoms that make modern life possible. And when finance bets on those atoms, supply and demand become malleable, shaped not just by mines and factories, but by contracts, vaults, and capital flows. Silver then becomes a metaphor for scarcity, for transition, for fragile systems sustained by invisible balances. What we don't know and can't see, no dataset can tell the full story. Vault inventories are opaque. Many institutional silver holdings are hidden behind shell companies or family offices. Off-exchange storage, private contracts, non-public holdings, they all create a shadow silver market. We do not know how much of the 1.13 billion ounces in ETFs is actually backed by deliverable silver, or how much is synthetic. We do not know how much physical metal remains accessible, unloaded bars, unregistered vault stock, scrap waiting to be refined. We do not know which actors hold the largest positions, and whether they are acting for long-term profit, strategic hedging, or as backs for industrial supply chains. In short, we cannot see the entire structure. We can only observe its effects: rising lease rates, shrinking inventories, price spikes, industrial stress. And in a system built on opacity, it only takes a small shock, a sudden supply disruption, a regulatory change, a wave of margin calls to crack the structure wide open. This moment, late 2025, early 2026, is not just another bull market. It might be a pivot point. If silver surges further, it could rewrite the rules of industrial metals. Solar panel makers, EV producers, electronics manufacturers might find costs skyrocketing. Supply chains might rewire. Alternative materials might accelerate development. The global green transition could stall or restructure under pressure. Financial markets might see dramatic volatility. ETFs might flow, but vaults might struggle. Deliveries might fail. Paper silver might decouple from physical reality. Futures markets could seize, prices could gap. On the other hand, those who acted early, who accumulated silver quietly, may find themselves holding not just a commodity, but a strategic asset. For them, the coming storm might not be a crisis, but a windfall. In that sense, the story is not just about silver, it is about power, about who controls resources, about who sees the cracks in the system and acts before the world realizes they're there. The vault closes. The screen fades to black, the hum recedes, but the weight remains. The bet on silver by billionaires, by institutions, by invisible hands is not over. The accumulation continues. The squeeze tightens. The stakes rise. As we stand in 2025, on the cusp of 2026, it is tempting to view silver as just another speculative rally, but that would be a mistake. Silver is more than a commodity. It is a crossroads of industry and finance, of green transition and resource scarcity, of visibility and opacity. What happens next, whether a dramatic collapse, a further surge, or a slow, painful grind, will reverberate across technology, energy, currency, and power. And if you think the story ends when silver peaks, you're wrong. Because silver isn't just a bet on price. It's a bet on stability of systems, of economies, of the very foundations we rely on. For those quietly stacking silver now behind vault doors, FX change under the radar, this moment may prove pivotal, not just for their fortunes, for the world. So ask yourself, when the dust settles, who will still hold silver, and who will be left holding nothing but memories of what once was a silent metal in a silent vault that changed everything? Fade to silence. The screen remains black,